Okay, welcome back, everybody, to a new episode of Who Charted. I am Dan Russo, Co-CIO at Potomac, here in Potomac Studios in Bethesda, Maryland. Today is Monday, December 22nd. Holiday shortened week this week and next, but we're not taking time off because we're here to talk about seasonality. You're going to hear a lot this week about the Santa Claus rally window or the SCR window. Most people get this wrong, so I'm just going to level set it right now. The Santa Claus rally window is a period of time, the last 5 trading days of the current year plus the first 2 trading days of the next year, where the stock market has a tendency to move higher. Now, tendency to move higher does not guarantee move higher. As a matter of fact, last year, 2024, the market was lower during the Santa Claus rally window. Now, if the market is higher over that window, that's perfectly normal. If the market is lower within that window, generally speaking, odds of some choppiness in the new year increase. And if you look at what happened early in 2025, the market started to top in February and rolled over into the whole tariff tantrums in the first week of April following a negative Santa Claus rally window. So let's touch, as we always do, on the charts. We're going to start today on a little bit of a different chart. We have the S&P 500 seasonality chart. This is the average weekly performance of the S&P 500 going back to 1950, right? So week 1 to week 52 of the year. Now, last week was a positive week, as we can see by that diamond there. The last 3 weeks of the year plus the first week of the new year tend to be strong. So we are in a seasonally strong period of time for the S&P 500. This week and next week tend to be positive on average. So we have seasonals in our favor. Now, at Potomac, we don't use the Santa Claus rally window, but we do use month-end seasonality and holiday seasonality as part of our composite models. So we've been bullish, right? We've been talking about the bullish aspects in the market for the past few weeks here. Now we're getting into a period of time where the seasonals become a tailwind for the market. So we want to be mindful of that, especially in light of the way the markets traded last week. Now, this is really important. For those of you who are purists on candlestick charts, which these are, last week's activity is known as a hammer. You can see these kind of look like hammers, I guess, if you want, in some cartoon sense. Essentially what happened here is the market tried to go lower early in the week and then snap back hard to close near the top of the range. Now, we've talked about closing near the top of the range in the past, and that is an indication that investors want to go home on a weekend, Friday, with risk. More importantly here, I kind of think of this one almost as like a sporting event. If you're into football, we're getting close to the playoffs, right? What happened here? The Bears ran with the ball, and then they got all the way to about the 2-yard line, and then they fumbled, and the Bulls picked it up and started running back the other way. All of this is playing out above the rising 60-week moving averages, so we shouldn't be surprised that investors want to go home with risk. The trend is higher, and dips are being bought, right? Dips are being bought. The trend is higher. Seasonals are a tailwind. Breadth remains strong. Remember the 3 legs of the stool. What's the trend? How healthy is the trend as measured by breadth? And what are intermarket themes telling us? Well, once again, new lows are non-existent, while new highs kind of remain steady up here. You can't have a bear market without new lows, right? And we have not had a spike in new lows since over here in November. And quite honestly, we haven't had a sustained extreme spike in new lows in quite some time, right? Simple fact of the matter is the market's going up. More stocks are making new highs than making new lows, and that is a healthy environment. This is the New York Stock Exchange. Thus far, we've looked at U.S. stocks, but I want to take a moment to look at international stocks, all right? This is the ACWI ex-U.S. Index Fund and a 10-week moving average. A lot of people might not know it, but international stocks are outperforming relative to the S&P 500. We have not been able to say that many times in the past 15 to 20 years, but it is happening this year. All right. Since the start of 2025, the ACWI ex-US relative to the S&P 500 here is outperforming. Right. My guess is most strategic portfolios are underinvested to international. So that'll be interesting to see how that plays out into 2026. Same hammer pattern up here off the 10-week moving average, right? So not only in the U.S. do investors want risk, but it seems internationally investors want risk as well. And then finally, I will leave you with what is probably the most impressive chart of 2025. After going sideways for 4 years, this is spot gold, right? So the spot futures, spot price of gold, just in a textbook, absolute face-ripping uptrend to trade near all-time highs, or actually we close at all-time highs. Long and short of it is, if you have gold on your holiday wish list this year, you're going to be paying more for it. So I just think this one's interesting. Wanted to leave it for you there. Thank you, as always, for taking time to listen to what we have to say and watch what we're doing. I hope everybody has a great holiday week. I hope you spend time with the people who mean the most to you. We're not taking time off. We will be back next Monday. So between now and then, have a great week, have a great holiday, and we will see you next week.